Professor Indra Abeysekera. In this workshop, one of the learning goals is for us to understand recording of accounts receivable, measuring them periodically, and recording the remeasured values. Accounts receivable is an asset, and it arises from sales. There are three types of sales we talked about, or three types of revenue. One is cash revenue or cash sales. The other is accrued sales, or it is also called account sales or accounts revenue, or the third is the prepaid revenue. But for our discussion, cash sales are where there's revenue that is generated and the cash is received. Either hard cash is received or the company receives the payment through credit card. So the credit card payment becomes cash immediately because the bank deposits money cash immediately into the company's bank account, although there's a small charge for using credit card facility, but the cash is received. Therefore, the credit card sales are considered as cash sales. Account sales or accrued sales are where the company agrees with the customer that the customer will pay within a given period, but sometimes the customer is also given an incentive to pay earlier, and if the customer pays earlier, customer receives a discount. But nevertheless, those accrued sales or account sales are also one way of generating revenue. Because the cash is not received immediately, we credit sales. We do not debit cash, but instead we debit accounts receivable. When accounts receivable is being received, we record that transaction and we give an invoice to the customer. Here's an example of an invoice that is given to a customer. And after a period of time, once we have recorded this accounts receivable and the sale, after a period of time, we may realize that the customer is unable to pay, or there's a general tendency that some of those account sales or the accounts receivable may not translate into cash due to various reasons. The customer can get into difficulty in payments or various reasons. Therefore, understanding some of these accounts receivable will not translate 100% into cash. The companies provide for those losses of not collecting cash. There are two methods of providing for those losses. The first method is called the direct write-off method, and the second method is called the allowance method. When the company knows a specific customer or customers cannot pay, then there's an actual bad debt. That means a money that cannot be collected. Actual. When the company knows there's an actual amount, company can write that off as an expense uncollectible expense, a lost money. That method of recording is called direct write-off method. The second method is where company don't know but expect some customers can have difficulties in payments. They look at the historical records of accounts receivable and find out that 2% of this accounts receivable will not translate into cash. So it's looking at the total revenue or the total sales and making an estimate of possible bad debts, not actual bad debts, possible bad debts. When it is providing, when the company is providing for possible bad debts, that method is called the allowance method. For instance, the company knows that there's an actual bad debt. Then it must record a journal entry to show that the money is definitely lost. So bad debts expense is a debit for the money lost, and accounts receivable that cannot be collected is decreased, and accounts receivable is credit. That is for actual bad debt, that is using the direct write-off method. The second method is where bad debt is expected, that it is possible, and the company is providing for it because it is an event that is taking place during the period in which the revenue was generated. Because of the revenue, there are possible bad debts. So it recognizes that estimate as a bad debts expense, debit 20, and it does not decrease the accounts receivable because it is a possible bad debt. Instead, it creates another account, a new account called provision for doubtful debts. Provision for doubtful debts, and it credits provision for doubtful debts. Provision for doubtful debts behaves like a liability account, but it is actually a contra account for the accounts receivable. Having talked about accounts receivable, we also need to understand that accounts receivable is one of the three types of receivables. Accounts receivable arise from trading, from selling, from generating revenue. Notes receivable is another type of receivable. Notes receivable arises from the cash to be received from customers where the company has given money on a promise agreement. It has not sold goods or services, but instead it has given cash, money. Then there are other receivables. Any receivable other than accounts receivable and notes receivable are called other receivables, and other receivables can take various names. Like if there's interest to be received, it's called interest receivable. So loans to be received, loans receivable, and so forth. It can take different names. So there are three types of receivables, and accounts receivable is one of them.